Welcome and thank you for joining us for today's webinar, Navigating Risk, Transforming Today's Challenges into Strategic Advantage. Before we get started, here are a few quick notes to help you stay connected and informed. Today's session is being recorded. We'll send you the link afterward so you can revisit the conversation or share it with your team. If you have questions or insights during the webinar, use the question panel in the upper left corner of your screen. We're here to engage with you. At the end of the webinar, a short survey will appear. It only takes a moment, and your feedback helps us shape future conversations that deliver the guidance and clarity you expect from Hub. Now, I would like to introduce our moderator for today's event, Tim Daset, President, North America Commercial Lines.
Hello, everyone. As mentioned, I'm Tim Daset, and I'm going to be moderating this conversation. Business leaders like you are facing extraordinary pressures, from capital constraints, geopolitical shifts, to rising insurance costs. Today, we're going to unpack some of these challenges, what they mean for your operations, and how you can respond with proactive risk strategies. We've brought together a panel of experts across professional and executive liability, property casualty, trade credit, and employee benefits to help you identify the risk, stay agile, and uncover the opportunities in uncertainty. Today, the panelists joining me are Whitney Ross. She's our Chief Claims Officer for Professional and Executive Liability. Jerry Paulson is a Senior Vice President in Property Casualty, devotes a lot of his time on helping serve our clients navigate trade credit and political risk exposures. Michelle Winheiser is our Executive Vice President, Property Leader, who's very focused on our complex property risk, and Jonathan Muscatello, who's one of our Senior Employee Benefit Strategies. So let's get started here. Team, we're going to get started with one of a core question here. Let's set the framework. So Whitney, start us off first. What are the risks that's most pressing with your clients today?
Sure. So in my discussion with clients, there have been a few top of mind risks that they've been concerned about. The first risk is really the ultimate financial risk when doing business, which is the risk of insolvency. And what is top of mind specifically for directors and officers is whether their personal assets are going to be impacted in a bankruptcy where a trustee may come in and allege a breach of fiduciary duty against them. I've had a number of situations like this where the bankruptcy trustee came in and sought to pull policy proceeds from the D&O carriers by alleging that the directors and officers breached their fiduciary duties to the company, somehow engaged in corporate waste, and unjustly enriched themselves, causing the company to fail. But insolvency can be the result of a number of things that occur during times like these, several of which are also top of mind for clients given the current geopolitical climate, like a cyber attack that interrupts a business for too long, or a securities class action with too large of an impact on the financial stability of the company, or simply the cost of doing business right now in the market. So to get a bit more specific, we may be seeing an increase in vulnerabilities through state-sponsored cyber threats against US-based companies. This could be a ransomware attack against the company that impacts it directly. It could also mean the possibility of a major shutdown that impacts businesses, which involves an attack on a vendor that the company relies on. So it isn't just the company's own systems that are at risk, it's the systems of others that could impact a business if that business is dependent on the vendor who is breached. So if customers are unable to do business with clients as a result, that could lead to lost contracts and lost sales. This cyber risk is tangentially related to layoffs, which I'm going to talk about in a minute, but layoffs can create vulnerabilities within an organization because of staffing issues. Companies that are short-staffed and employees that are overworked can accidentally allow a threat actor to gain access, resulting in a ransom attack. This is a real possibility. This recently happened to a client of ours after there were reductions in force, leaving a very limited number of individuals working under tight deadlines. One of those individuals, in quickly jumping from emails, clicked on a link, downloaded malware, which led to an attack. The company was down for weeks, and we anticipate the BI loss could be in the millions. Other risks that are top of mind for public companies, given the current state of the economy, are plaintiffs' firms filing securities class action lawsuits based on volatility in the market, attempting to tie a stock drop to some misrepresentation or omission. Companies that are looking to go public may be hesitant to enter the public arena as a result, and we might see fewer IPOs during this time. I just read in the news that while IPOs may have nearly come to a halt, special purpose acquisition companies, or SPACs as we like to call them, might be coming back. And I saw that sponsors have raised about $2 billion just this month alone, seeing this as possibly an opportunity. On the flip side, we're likely to see fewer regulatory investigations and actions initiated against public companies given the current administration's political views on SEC oversight. But a final risk I'm going to add here is that employee layoffs may occur due to the growing costs and concerns around budgetary issues. What happens with layoffs, though, is that there is a potential for increase in employment claims. And those claims could be for a variety of things, like wrongful termination, retaliation, discrimination, or even all three at once. So while companies have the ability to cut costs through downsizing employee count, they also have the concern of future claims and litigation that can be very expensive depending on different factors. The jurisdiction in which the employee resides, let's take California, because that's that obvious one, could increase exposure. The allegations themselves could create a greater chance of liability, like employees that were selected to be let go because they were in a certain protected class, like they were over a certain age. And the salary of the employee, like in the case of a high wage earner, that may bump up the damages, all of which the company may have to deal with on the back end of layoffs. So, Tim, these are risks that are top of mind for many of our clients in the areas of professional and executive liability as they try to navigate this uncertain environment.
Yeah, thank you, Whitney. Jonathan, you heard Whitney talk about, financial capital challenges and human capital challenges. So let's stick with the human capital challenges there. Tell me, what are some of the risks you're seeing, in your space?
Thanks, Tim. And I'm going to just play off of what Whitney kind of ended there with, which is layoffs. Since the Great Resignation happened during the pandemic, the turmoil around voluntary or involuntary terminations is a real threat to any business today, from litigious actions, as Whitney was talking about, but also from a productivity standpoint for an employer. Not only that, but a safety risk as well. We know that a distracted employee can cause safety concerns. So I think that's an important part. And what we're doing on the employee benefits side is really trying to understand where that employee is in their life cycle. And to do that, we use our persona analysis, and that kind of gives us the foothold and the starting point to talk about it. From other risk perspectives, I think of the cost of pharmaceuticals and the raising costs that they are. 10 years ago, a pharmacy spend might have been 10, 15% of an overall premium. Today, we're talking upwards of 40%. And the cost of drugs are just continuing to skyrocket. And, there's drugs out there that are $5 million a dose, and we don't even know if they're going to work or not. But how do you tell an employee that has a rare condition that you're not able to access this drug? So there's a fine line that we're walking there from a pharmaceutical perspective. And I also think about just general, distractions from home and how that can cause rift inside of a workforce, whether that's a cultural difference between employees or leadership and what's going on there. And so there's just a multitude of things from a benefit side that can pose risk for an employer.
Thanks, Jonathan. Hey, Jerry, among other things, you're heavily invested in helping clients navigate liquidity challenges. What are some of the things that you're seeing in your space?
Thanks, Tim. Yeah, it's a busy time for us in a variety of different categories, but like a lot of things, it all boils down to cash flow, liquidity, and increased costs have been affecting liquidity of businesses for some time now. It's nothing new, but it's heightened more than ever, and it's affecting all business sectors. We are being pulled into conversations, my team, every single week, whether it's services, goods, manufacturing, logistics, all business centers are being affected by liquidity challenges because the last several years, severe inflation, increased interest rates have affected both your local operations and or global supply chains. Only recently have current policies created uncertainty with tariffs or geopolitical rifts that have magnified the ever-growing challenges around supply chain issues and really bringing this problem to a head. So as it's affecting everything in a business's operations, from input costs to selling costs, uh, salaries, and so on, it's making everything more expensive. And Hub Advisory Services, we are able to help think through different ways to help solve that problem. Later on, we'll discuss specific examples about bringing liquidity, whether it's real or synthetic, to a balance sheet and freeing up that working capital to also explore risk transfer and help company thrive through this opportunity or these challenges with new opportunities.
Yeah, thank you, Jerry. Yeah, it seems like the liquidity, I wouldn't say crunch, but tightening has an impact on a lot of different lines of businesses. I know specifically, we're seeing that again now on the casualty side for clients who are, retaining risk, and the retaining risk because of the severity of cost, and therefore that requires collateral requirements. So be interested to talk to you about that more later on. Michelle, from a property perspective, I mean, who would have thought property, but has such a broad and impact? You're seeing a lot of things. Can you share your insights with us?
Absolutely. As I think about some of the things that are going on, aside from tariffs, geopolitical tensions, inflation, all of these things can really fundamentally impact a client's operations. And when their operations change, so does their risk profile. So whether that's sourcing new suppliers or rerouting distribution channels or making adjustments to timelines now to secure critical construction materials or machinery and equipment or components, these shifts just require a different interaction now with the insurance policy to go back and make sure that there's coverage adequacy. And one of the biggest challenges that we're seeing is really the disruption in supply chain and how that's also changing recovery timeframes. But potential consequences as a result of changes in the supply chain are supplier volatility. And as if your supplier overseas, are they still doing exporting? I've got some clients who are saying that they're no longer exporting from the US to overseas. And now, if you're identifying new sources, do they have the capacity to fulfill orders expediently? And then the other piece of it is, if they're manufacturing goods on your behalf, can they manufacture to your high quality standards? And down the line, what you'll see is increases in cost. And then those impact your overall sales, profitability, budgets. And then when you get into some of the bottlenecks, it could be that items coming overseas into the United States are being held up by customs. So these impacts on timelines are just another piece of the equation that need to be managed very tightly. And as you start thinking about rising costs, this impacts rents, and that's going to impact vacancies. So all of this is really just going to lead to potentially some more underwriting questions at renewal, specifically around valuations and how values are being determined. But then also maybe some questions about vacancy and how it's impacting real estate buyers. When you start really focusing in on just staying with the whole theme of supply chain, when vendors are adjusted, so could the catastrophe footprint. And sometimes that happens unknowingly. You could have a supplier who's in a relatively benign catastrophe area. You can't really say non-cat anymore because I feel like cat exposure is everywhere. But if they move from a benign cat area to a high cat area for tropical cyclone or earthquake, flood, wildfire, suddenly now you need to really look at the whole landscape on how your contingent time element coverage is going to respond. And some areas that you would specifically really focus in on would be, first of all, some policies have a requirement to specify your suppliers. So you want to make sure that your suppliers are specified. And then you want to make sure that there's limit adequacy. But then you also want to make sure that the territory and the catastrophe exposure mirrors the geography of the supplier. So if the operational or geographic change is not captured in the policy, then certainly you could have a claim fall outside the scope of coverage. And that's a really bad day in brokerage. Not one of those phone calls I want to make. So I think it's important to have a good handle on your business income values and timeframes for recovery. Also, really important to make sure that your replacement cost values are in check. And all that's going to go a long way to making sure that there's good adequacy in your overall supplemental liability and policy limit. I'll hand it back to you, Tim.
Yeah, no, thank you. And all of that, just a couple months going into, cat season, right? Like you said. Well, obviously there's a lot of challenges abound. Let's ground this conversation in action. All right. So team, let's talk a little bit about what are clients not thinking of that they should be? And then what are you advising them to do right now? And Whitney, let's keep with you as a start here.
Okay, so obviously it's a two-part answer insofar as I like to address both something clients aren't thinking about and what they should be. Playing off a little bit earlier of what Jonathan said about employee well-being. Now, this isn't something anybody really wants to think about, but workplace violence should be top of mind in the current environment. With the potential rise in layoffs, there is a potential rise in disgruntled employees, not to mention financial stress that employees may be facing. So there may be a higher risk of violence in the workplace. So in addition to preparing for an event, I think clients should be speaking with their broker about workplace violence insurance coverage, how to get it, what it covers, and how their broker can be their partner through a workplace violence event if that happens. So what is workplace violence coverage? Just very high level. It can extend to intentional acts, threats of deadly force, and even stalking threats. The losses that are covered are pretty broad. They include personal accident expenses, public relations, salaries of victims, medical, psychological, security fees, liability, and even business interruption. Here at Hub, clients are walked through a training orientation that covers violence trends in the workplace, elements of coverage, a comprehensive approach to violence prevention, and workplace violence prevention planning resources and tools. So this is no doubt an uncomfortable topic, but given the state of current concerns, I think we should be taking measures to prepare for everything, including a workplace violence event. In terms of what clients should be doing to remain resilient in this uncertain environment, I'm going to tie this part back to the risks that were top of mind for clients that I mentioned earlier in our conversation. So as it relates to employee layoffs, clients should be complying with company policies and handbooks, consistently applying policies to all employees, and maintaining thorough documentation of employee interactions if layoffs are going to occur. As it relates to cyber threats, clients should make sure they have an up-to-date incident response plan and make sure that any third-party contracts to address indemnification in the event that the third party's breach impacts the company's business are in place and are tight. As it relates to potential securities violations, I think directors and officers should be very vigilant in their decision making and what they include in their disclosures in their SEC filings. And then over all of this, from an insurance perspective, I think clients should be reviewing their coverages for risks that we discussed today, whether their limits are adequate using best-in-class modeling. Hub uses the stochastic cost of risk modeling and review for best-in-class language that's available in the market. Clients should understand their coverages that they have in the event that any of these risks potentially hit their policies. Clients should be looking at their claims advocates to provide training on their coverages so they understand how their policies operate in real life situations. So something we do here is a worst day scenario training for our clients. So let's take, for example, a public company. We'll sit down and walk through a scenario involving a stock drop, which results in a books and records demand, a derivative investigation demand, a securities class action, and a regulatory investigation. So worst day. By the end of it, the client's going to know their coverages, the process, what's expected from an insurance perspective each way through the process to resolution. This way, the client's going to stay focused on the claim if and when it happens, and we can stay focused on making sure that the insurance response is intended to protect the company and its directors and officers and its employees financially to navigate the time of uncertainty that we're in right now.
Thank you, Whitney. And as I was thinking about all the advice you were giving there, I'm constantly
It was a
amazed.
lot.
Yeah. Well, having our claims team and our brokerage team working together and advising our clients, I think is really differentiating. You just highlighted it there for us. So thank you. Michelle, you sit in front of so many of our clients, advising them on their property issues. What are you doing to advise clients right now?
I think what's really important is to make sure that there's a really good collaborative discussion at the renewal strategy meeting or stewardship meeting in order to make sure that that we're understanding any changes in operations, that we're also making sure that there's that opportunity to perform that broker audit. We want to make sure also any values are adjusted as needed. So working with a hub property risk consulting operation to look at the CoreLogic product, the cost per square foot in comparison to the client values, but then also brokers advocating with those same tools for clients whenever insurance carriers are trying to push valuation increases. So there's kind of a twofold there. I think another key and an important piece of it too is really engaging with, like we have an organizational resilience team, other brokers might have disaster recovery or business continuity, but making sure that there's some mapping of your different suppliers. And I think that's a really important, project that needs to be tackled. Sometimes those are a little bit more daunting. They could be longer duration of a project to tackle, but definitely one worth pursuing. And then on the forensic accounting side, I like to engage our forensic accountants mostly to help establish values on that pre-loss basis. But then if they have an untimely claim, that's obviously their engagement is really critical on a post-loss basis as well. But forensic accounting can help make those adjustments to the business income values in light of the factors that you're facing today, help provide training, also make sure that across your operations that there's some uniformity in how the calculation is being developed. And then sometimes those changes in the business income values are actually reducing your overall exposures. And the reductions in your exposures can result in another reduction in premium because of that significant change. Anytime that we're talking about values, I think it's so critical to talk about, hey, it's time to rerun analytical tools. Everything you do in insurance on the property side really starts with values, and it kind of goes through modeling and then what you'd recommend for limits, and then it all kind of flows through to how a carrier will price your business. So we want to make sure that, catastrophe models are being rerun. We use VeriRisk, AIR catastrophe modeling. It's a great time to rerun, make sure that there's adequate catastrophe limits that are being negotiated. And then also if there's midterm changes that need to be done, that there's an opportunity for those limits to be secured. One thing that I think is a little bit of a unique play, but I know one thing that we have available is we have a managed restoration vendor program. We call it our MVP program. And what it affords buyers is access to pre-negotiated costs for restoration services. And what I love about it right now as I think through it, Tim, is just that there's pre-agreed cost for their engagement. And when you start thinking about rising cost increases, it's kind of an opportunity to keep those costs down if they're pre-established. So I like the idea of it. I also start thinking too that if a claim occurs, the longer that claim stays open, the larger those claim amounts go. So having somebody boots on the ground, get into the site, restore it, get things up and operational as quickly as possible mitigates that claim. And that could be partly the client's deductible, or it could be partly risk transfer, but Claim amounts in general are often considered when the property premium is developed at renewal. So I think making sure that that the claim process is really well managed in the restoration process. But going a step further and really just thinking, okay, well, if clients have really aggressive cost measures, what can be done to really hack into the overall premium? And I think for us, we use a lot of analytical tools, Hub Predictive, and other tools to help us control the risk profile narrative into the market and make sure that we're generating a lot more competition. And then what competition gives you is optionality, right? And who doesn't like options? I like
That's right.
options. I hear a lot of clients say that well, not clients, but future clients say that they just didn't get options.
Yeah.
So, you want to make sure that you're giving them the best that there is available in the market. And then having a broker quarterback that strategy in the world market to bring all that competition to light, find how you can get all the markets to best play within a program, that the pricing is as efficient as possible. And then now that you've established a new and fresh baseline and most efficient program pricing, what other strategies can be overlaid? And a lot of buyers are like, hey, I would love to take on more risk. I'm willing to bet on myself. And when you really start thinking about that, there's mechanisms such as quota share self-insurance for buyers with layered and shared property programs. They can take on a little bit more risk, and it doesn't really change the overall program structure. There's also an ability to take on a self-insured layer to look at alternative risk transfer products such as structured risk. I like to call the dividend plan. It's a little bit of a simpler concept, but if you perform well in terms of losses, you get some of your premium back, up to 30 or 40%. That's again more on the large complex side, but there's some of those products can apply to middle market buyers also. And then when I start thinking about some of the recent conversations I had, even this week, I had a client who said, we don't want to crawl, walk, and run. We just want to put all of our property risk into a captive. And I'm like, well, we have captive specialty group available to help talk through that. And you could, start slowly, but you could also just, just jump right into it. And it's ideas like that that will really help clients contain some of their overall risk transfer cost.
Okay, well, I appreciate that, Michelle. Definitely all those decisions need to be mired in and supported by analytics, but it's definitely what we're capable of doing. Jerry, you had some, advice as well as some alternative strategies you wanted to share. Please elaborate.
That's right. Keeping in the theme from Whitney and Michelle about there's some things to do that involve insurance. It's just good business practice, and then there's some products and solutions to really meet some needs. The key thing that we're doing here is giving good advice, trying to help people that are managing risk, whether it's a risk manager, a CFO, treasurer, think through what could happen, as well as what is happening. And there's two key areas that I highlighted earlier. First is supply chain, and then second is liquidity. So just good advice is don't put off good business practices such as strengthen your existing supplier and customer relationships, whether that's visiting them, speaking with them, talking about what are we going to do if tariffs hit. It may or may not already be currently contemplated in a purchase agreement or some type of contract. And so you should talk about, well, what are we going to do when this affects us? Are we going to share in the costs? Are we going to have it be absorbed by one or the other? What are some of the offsets that can be made? And frankly, that may lead to a different way of sourcing product, and that's going to be affecting both suppliers and customers. And knowing where you stand is really important, and that starts with communication. From a risk transfer approach, there's a few things that we're helping clients with. One right now is someone who did have those conversations early in the year. They're a manufacturer that assembles products that come from all different parts of the world. And frankly, because the supplier did not want to share in some of that tariff pain that was impending, they had to evaluate new suppliers. and that meant changing from one country and its regulations to another. And so part of that risk mitigation thought process that we help them walk through is trade disruption insurance that encompasses supply routes, catastrophic events such as cyclones or geopolitical interference, potential delays at ports or embargoes, things of that nature. And we were able to help them price what a disruption might cost the business. From a sell side, there is trade credit insurance that helps expand sales, doing so safely and securely, not just because of increased input costs that lead to increased finished goods, but taking advantage of the change in the global supply chain. Frankly, just this last week, we had a client that's doing a project in Canada that is looking for more liquidity, and they've asked their supplier to get trade credit insurance on them. And we coordinated with our Canadian counterparts to work with a local Chicago supplier to get credit insurance that allowed them to safely and securely win a bid of a large project in Canada. And then from a political risk insurance perspective, we are working more and more with private equity owned portfolio companies that have assets, whether it's a physical asset, like a big piece of machinery that's not easily mobilized and moved. It may be a manufacturing site or equity interest in a foreign enterprise that could be attacked or targeted as being owned by U.S. Private equity, and there's insurance to protect that equity interest. So there's a smorgasbord for you of examples of what we're doing in real time every week, and then I'll move on from supply chain into liquidity. There's a few different ways that most treasurers, CFOs, and risk managers that have a seat at the table can impact liquidity of businesses of all types, as I mentioned before. Number one, easy, communicate with your lender. Understand where you stand and where, what ability you have to upsize that facility. What can you do there? There's some other ways to create liquidity through financing solutions like selling your accounts receivables. You could do that in an off-balance sheet manner to increase cash flow, increase working capital, and receive that capital faster. And then one of our favorites is what's happening now with collateral replacement of letters of credit. So we have a client that has a $100 million working capital line of credit. And we found out through just general inquiry that they were looking to increase that line by 10%. Well, anybody that's been involved with a working capital line of credit with a U.S. bank knows that the review of that, the legal process, and then actually effectuating that increased line of credit is going to take 6 months at best. And this client did want to capitalize on opportunities to make a small acquisition. And so as we learned about that, we also identified that they had between 10 and $15 million worth of letters of credit being posted as collateral for their workers' comp, for some state and local regulatory bond issuances. And what we were able to do is through a few different methodologies, and there's a handful out there, replace those letters of credit with an insurance-backed solution. Some are secured, some are unsecured, but it immediately freed up $10 million of liquidity in their bank line so that they could make that acquisition. So I'll leave you with this. In chaos, there's opportunity. It doesn't all have to be doom and gloom. Some of these exogenous forces and policies that are coming upon us can actually be an opportunity to help our clients grow and manage risk, and it makes our job exciting.
Yeah, that's fantastic, Jerry. Yeah, there's definitely been more alternatives that have been developed for those alternative collateral requirements, and yeah, just finding some even partial, you add up enough singles and you get to home base. So thank you, Jonathan. You guys have done some unique things on the employee benefit side. How are you advising your clients today?
Yeah, Tim, and thanks everybody for this conversation. I think it's been great. It's always fun for me to hear what, Michelle's doing on her team or Whitney's doing on her team, and Jerry, of course, as well. But like when I think about what Michelle and Whitney were talking about modeling and worst day scenario, or some of the modeling that Michelle was talking about, we're doing the same thing from the employee benefit side, but oftentimes it's modeling what their funding mechanism is, right? So traditional fully insured is very turnkey. You pay the same premium every month, and the money goes to the carriers, and whether you spent that money in claims or not, that money still goes to the carriers. So what we're starting to do now is starting to look at different funding mechanisms. Again, on the other side, on the property side, there's captives, and they've been around for a long time. Medical captives are starting to become bigger and bigger players in our world today. Probably maybe around the last 15 years, they've really started to be established, but it gives really the ability to do multiple things. One, you're self-funding, you're sharing in risk, which is the second part of it, because now even though you're underwritten by yourself, you're sharing in a risk layer with the entire captive. So if I don't have a large risk appetite, I can go into a captive. But three, it gives you the control to do what you want, right? We can pick your own TPA, we can pick your own pharmacy benefit manager, pick your own carriers. Those limits are those possibilities are tremendous for an employer, because now we can start to add in cost containment strategies to really lower the claims that are being utilized, but also to better, to give your employees a better health outcome. So that's what we really want, right? At the end of the day, better health outcomes, yes, they lower claims, but they also save lives. And so if we're able to do that, we're really truly affecting the employer as a whole. I think about I talked a little bit earlier about our persona analysis and what we do with that. We worked with a tech company, maybe 100, 150 employees at the time, but low average age. Their average age was 35. They had a Cadillac plan, $500 deductible, all the bells and whistles. But the reality is, they might have been over-insuring their employees because they're younger, they're not necessarily at health risk, and they're not going to the doctor. So what we talked about was implementing a multi-plan strategy. So you have your base plan, then you have a buy-up plan, which would be that $500 deductible, and then a buy-down plan or a high deductible health plan. We lowered their overall premium by about 15%. And what we saw was a high adoption into the high deductible health plan, because people are able to take that as a tax advantage. This is a tech company, high earners, so they were able to put some of those dollars into the HSA, which lower their taxable income. So it was a win-win for everybody. Employees got the choice that they wanted. The employer saved money. And at the end of the day, you're providing a benefit package that is a Fortune 100 style benefit package. So those are the types of things we're doing on the employee benefits side, to really focus on overall outcomes. And the other thing to think about, we talked about the cost of drugs rising, and modeling, again, going back to it. When was the last time you looked at your pharmacy contract? We have pharmacists on staff, we have MDs on staff that are going through claims and drug utilization to make sure, one, the prescribing drug is the right drug for that instance, but two, also that we're making sure that whether it's a pharmacy rebate, that it's a pass through wholly to the employer, or if there's a per employee per month rebate associated with that as well. So we're always kind of reviewing contracts and making sure that they're in line for our employers or our clients to have the best outcome. So many things to talk about, Tim. It's crazy.
Yeah, it sounds like it. Well, I will say this, I'm honored to be on the same team with you guys. It's obvious to me that, you bring the industry expertise, the technical expertise, and a genuine enthusiasm for helping our clients. So thank you very much. Well, you've heard it from the team. Today's risks, they're layered, they're evolving, but they're also manageable, as you've heard, with the right strategy. So what can you do now? Here are a few takeaways that we talked about, from our conversation. One, reevaluate your program. What's changed since you last renewed it or last really looked at it? Review your structure and your values. You heard from Michelle that they're key. And are they aligned with today's cost, today's financial objectives, and the options that you're really looking for? Talk to your broker now. Build a proactive strategy that addresses those priorities. Think bigger than insurance. Think people, process, culture, communication, and desired outcomes. Insurance is a form of capital, and it can be used as a form of capital, as you heard from Jerry. At Hub, we're here to help you navigate the risk so you're ready for tomorrow. When you're at Hub or with Hub, you're at the center of a vast group of talented professionals in risk, insurance, employee benefits, retirement, and wealth management, and that they're bringing clarity to what I think is a constantly changing world. Thank you to our panelists today, and thank you for everyone that joined us. Please take a survey following the end of this call and let us know what is top of mind for you and how Hub can help you address them. Have a great day.